Hey everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. Is it a case of see you in September? For those of you old enough to maybe remember, that was a hit song back in the day. But for the fifth meeting in a row, the Federal Open Market Committee decided to keep rates unchanged, and that leaves Fed funds trading in a range of 4.25% to 4.5%. And, while it may seem as if the policymakers have not done any easing in this cycle, remember the level for overnight money is 100 basis points below last year's peak reading. And once again, the decision to keep Fed funds at its current level came as little surprise. And so now attention turns to the next official FOMC gathering, and that is in September. And obviously, the political pressure on Chairman Powell to cut rates has been ratcheted up of late, but it does still appear that the majority of the voting members to continue to feel the best monetary policy path going forward is to sit back and wait to see how the economic and inflation landscape unfolds, given the uncertainties that have arisen emanating from tariff-related developments. More on that a little bit later. Powell has been consistently expressing his opinion that the uncertainty surrounding tariffs had placed a cloud of sorts over the macro outlook going forward. In other words, policymakers see risks going forward to both aspects of their dual mandate, and that's employment and inflation. And these increased risks for both maybe higher unemployment and maybe higher inflation places the Fed in a challenging environment. And as we sit here at the present time, a highly data-dependent Fed remains in place. So how are the underlying economic and inflation backdrops looking as we are now in the second half of the year? And after posting a negative reading in Q1 due to a surge in imports, that was all reversed out, and growth for the April-June period rebounded into the plus column. Labor market data have continued to show resilience, and the July jobs report, due out in a couple of days, is expected to reveal some potential modest slowing in new hiring, but with total non-farm payrolls still increasing by over 100,000, and the unemployment rate, while maybe ticking up, remaining at a low point of 4.2%. Don't forget, weekly jobless claims, one of the leading economic indicators, also remain low. So what about inflation? And if you're looking at it from the consumer price index perspective, investors recently witnessed the possible end to the disinflationary trend that had been prevalent from February through May of this year. Both the headline and core monthly CPI readings showed some uptick in June, and that was the first potential signs of maybe some tariff-related effects. But the increases were still marginal, and overall inflation has remained well behaved thus far. So if there's going to be any evidence of tariffs visibly impacting price pressures, it's expected to start showing up in upcoming inflation data. Now, not too surprisingly as well, the July FOMC meeting did see two dissenters, Fed Governors Waller and Bowman, and both of these voting members had recently stated in public that they could support a rate cut at this just concluded meeting, so their vote against the majority was kind of expected. However, it does underscore shifting opinions within the broader FOMC. So looking ahead here on the bottom line, while September is the next scheduled month for an FOMC meeting, the Kansas City Fed's annual Jackson Hole Conference is slated for August 21st to August 23rd. Now, Fed Chairman Powell has used this venue in the past to communicate any potential shifts in policy thinking. In other words, if the FOMC could be getting closer to a rate cut, or perhaps even not, investors may not have to wait another 7 weeks for that kind of guidance or result. But for the record, Powell and company are still skewed toward rate cuts overall, something to keep in mind. I'm going to end it there. Have a great rest of the week, everybody, and be well.